Hi, this is Jennifer Schoenefeld welcoming you to Aftershock Publishing's February 5th, 2013 video update with Bob Wiedemer. Bob, the jobs report just came out and it looks like manufacturing is changing in a big way.
Well, that's exactly right. Manufacturing has been a big source of job growth since the, quote, I should say during the recovery, since the recession. We've seen job growth in manufacturing be 25, 30,000 a month or more. So it's really been a very important component of job growth. However, what's happening with this most recent report, we've seen job growth in that report in manufacturing go to basically flat, zero. And it's been part of a trend for the past few months. Things are changing. So let's take a look at this chart that I have up on the screen. And as you can see from the blue line, which is manufacturing jobs, we certainly have lost a lot of jobs. The big drop started back after 2000, 2001. And what we're finding is that, of course, it dropped again after the recession. So you can see how much we've lost. We're probably never going to make that back. But at the bottom of that drop, you can see since 2010, we've had a nice little increase. Maybe it's not big compared to the loss, but it has been a nice steady increase in jobs. Yet over the last part of that, last few months, you can see a flattening out in that blue line. And that's what we're finding right now. It's not really decreasing, but we're just not getting much job growth. And the reason for that is, no surprise, the world economy is slowing down. In fact, we're seeing negative growth in countries like Germany, Italy, Spain, Britain, Japan. So all the major countries are actually seeing negative growth. We're seeing very slow growth in some of the stars earlier, like Brazil or Australia, that are seeing growth rates of 1% or sometimes less. So it's been a real big change, and all of those goods that they used to buy from us, manufactured goods, well, they're not buying as many of. And let's keep in mind that although we do export a lot of commodities, our primary export is definitely manufactured goods. So a change in the export markets is huge for our manufacturing sector. What's the one bright side? Certainly cars. We had a pretty good growth in car sales last year, and I would expect that to continue going forward next year. So we're going to see that as helping to offset some of the decline in exports into the world markets. But overall, expect that growth in manufacturing jobs that we've seen over the past few years is going to slow down throughout this year. May not decline more, but probably we're not going to see very heavy growth, certainly not like we've had in the past.
Okay. One of the big drivers for jobs in the past has been the boom in oil and gas. And how is that looking now?
Well, it has been a big boom. One of the things about the oil and gas boom, well, to put that in perspective, just how big, Texas, our biggest oil producer, actually doubled its production of oil over the last few years. So it's been a big change. That's required a lot of jobs to do that. And what's most interesting is they are American jobs. All the equipment, or almost all the equipment used in the drilling for gas and oil, production of oil and gas, has all been made in the U.S. And certainly the jobs that drill those wells and service them are all made in the USA. So it's a good source of U.S.-based jobs that are high-paying. So it's really been quite a boost to our job market and to our economy. What's interesting about the oil and gas boom, and not talked about much lately, is the leading indicator, which is rig counts or drilling rig counts, have changed rather dramatically. Let's take a look at this chart that talks about drilling rigs. As you can see, there are two lines on this chart. The red line is natural gas drilling rigs. And we can see that it's really fallen quite dramatically in the last part of this graph. It's been about the last year. In fact, drilling rig counts for natural gas have fallen by almost 50% over the last 12 months. So a big decrease. And this is just simply a result of the low prices. Well, the low prices may benefit you, me, and a lot of companies, but they don't benefit gas drillers and gas producers. In fact, as the Exxon CEO said, we're losing our shirts on natural gas, and they sure are. It's not profitable. So they're cutting back on the drilling very dramatically. In terms of oil, though, that green line, you can see it's been just the opposite. Oil prices have not been that bad. They've actually come up a bit more recently. So we've seen oil rigs going from a low point in 2009 of about 200 rigs to a high point of almost 1,400. So a 700% increase in just a few years. Pretty massive. However, more recently, the change is in the last year, we've only seen about a 7% growth in oil rig counts. More importantly, in the last 6 months, we've seen the oil rig count actually drop a bit. Not a lot, but about 5%. So I think that's very telling. And what we're seeing then is that we're probably not going to see as much growth in jobs related to oil and gas drilling, and that also means oil and gas in general. Not that it's decreasing, but just the growth that was there is not going to be there. And of course, clearly on the natural gas side, when you have a 50% drop in drilling rigs, that makes a big difference. In fact, it's been so much of a decrease that likely in the second half of this year, we're going to see a decrease in natural gas production. Oil probably continue to have an increase in production, but nothing like you did before. When you grow rigs from 200 to 1,400, expect you're going to have a lot more oil. But if that rig count stays flat or goes down to around 1,300 or 1,200 for oil, we're not going to have an increase in production. We'll be able to maintain a lot of what we've already drilled, but the increases won't be nearly as strong as before. So should be an interesting period, but that's a bit of a leading indicator of what's going on in the oil and gas industry and in the jobs particularly.
Okay. Well, wow. Thank you very much for your insights today.
Well, thank you.